some of these lawsuits that have been going around to like General Electric, Verizon, MetLife around their 401k plans, and they've been getting sued by law firms because what they've been doing is they have like their advisory fee similar to like what we have, but then they've been lumping in all of their own their own funds in there, so their own mutual funds. So like if the plan has like a General Electric or Verizon, you're talking hundreds of millions, if not billions of dollars within their retirement plan. And then the vast majority of their funds are also the same company that's providing the plan. So they're getting double whacked by the mutual fund that they're invested in, plus the advisory fee that they're all getting hit for.
Welcome to the Half Truth, where we discuss headlines that are in the news for the past week and talk about the part of the headline that is true, but the underlying reality of the other half of the headline that's probably not so much true. I'm Patrick Moorhead, joined with Justin Singletary, and today is Friday, October 13th, and we're going to cover a few of the topics that happened probably the last 2 weeks, since it's been a while. So welcome, and Justin, welcome. Happy to have you here again.
Yeah, I'm officially 40 now.
Oh, shit.
Thanks.
That's why he shaved his head bald, so you can't see his gray hair. Why don't you kick us off with the first article?
All right. So welcome back, everybody. So I'm actually going to go with, so there's been some over the last few weeks, and before we even jumped on, Patrick and I were talking about this, but so I came across an article titled MetLife, latest in the string of 401k lawsuit settlements. And so what I've found really interesting is I've seen a few of these over the last 2 weeks, and apparently companies like General Electric, MetLife, Verizon, to name a few, have been getting sued by law firms in favor of the employee because essentially what these big companies or institutions have been doing is they have their 401k plans set up through like an American Funds or Fidelity or one of those, and they charge, the investment firm that's running the plan charges a fee to the business, to the overall business. And then they also, within inside the fund, all of the employees, what investments they have access to are usually the firm that's providing the 401k plan. So if it's Fidelity, you'll find a whole bunch of Fidelity mutual funds. Well, if you watch some of our other videos, you'll realize we've mentioned on a number of occasions that typically mutual funds are going to be a very expensive way to do your investing as far as retirement goes. So because of that, those mutual funds have a fee, a very high fee. So essentially these these big companies, Verizon, all of them have been getting double dipped against by whoever's running the plan. So if they're paying, a 1% fee or even a 0.5% fee on the overall plan, and then they're, the only investment, the lineup that these people get to choose from are the same investments from the plan, each one of those mutual funds has, an expense ratio or an expense fee. And those are usually another 0.5% or 1%. So if all you get to choose from is the funds that they provide, is the funds from the plan, I'm confusing myself here, but so if Fidelity is the plan owner, the person that runs the plan, they have Fidelity investments. They're getting, the plan, the employer is getting double dipped on by fees because they're getting fees on the mutual funds as well as on the what they're charging for the plan. So it's pretty interesting. I know that we've talked about this and this has been an ongoing problem for years, but it sounds like some law firms are actually making headway on suing some of these companies.
Well, and that's good too, because I mean,
Right.
the industry is so regulated that we're supposed to show fees in every aspect of that a financial advisor does, but they don't have to. Like, that's what clients don't understand, is that they're paying all these fees. So like, if a normal advisor charges a fee, a client gets all upset that, oh, this is diminishing returns and all that type of stuff. but you don't see the underlying aspects of all the fees that your account is being charged because they don't need to disclose that. Like they disclose it, but you don't realize it happens in the background. So you don't realize that you're getting paid that. So that's great that is actually happening.
Yeah, I agree, and I'm going to give ourselves a plug here. So we've actually started doing 401k plans, the last year and a half, 2 years, and one of the things that we've come across, even in the small businesses, is we'll find a small business that's doing call it 10 to 20 million dollars a year in revenue, and they've got maybe a 10 or 15 million dollar 401k plan spread out between all of the employees, and the person that's running it is, like an American funds. And then all they have, their investment choices are American fund mutual funds. So it's like we're seeing it on the small end as well as on the big end. So, one of the things that we do is we offer exchange traded funds in ours, which are a much lower cost than your average mutual fund out there. But anyways, quick plug. So that was one I really thought was cool, and like we both said, very very good to see that people are finally having to to be held accountable for it.
All right, my headline. I always like to start with Jim Cramer. So CNBC, he's got his stupid club thing, and it's funny when he tweets something, it's all negative. Like people always bashing him in all of his comment section of the tweets. But he came out. This was probably yesterday. That says Cramer on why a hard landing. So he's talking about a recession is unlikely and why it's time to own stocks. So this was what, yesterday, the day before. In true Cramer fashion, as soon as he posts something like that, stocks turn, and we were down now. Yeah, especially in the Magnificent Seven, we're down over 2%. So I love it when he trades or says things like that. It just makes it so ideal.
Puts a smile on your face.
Yep, every time. Every time.
You and everybody in that inverse fund of Jim Cramer's.
Yeah. Well, and even so, another headline on a guy that I love, like he's great at marketing, to go in kind of line with your mutual fund thing of he hates mutual funds, is Ken Fisher. Now on the flip side of things, he's no better than most advisors out there. But he came out last week, I think, and said, "Don't be fooled by the bears. Billionaire Ken Fisher advises investors to stay put." And here's two stocks that he's heavily invested in. So part of that is a little bit of, a push, ad kind of, headline or whatever, but it is comments that he made that, he's your typical advisor. Just ride it out. It doesn't matter if the market's turning, going down, just ride it out. You're better to be invested than not invested, and that's just not the way to kind of be looking at it. And so I think it's funny that all these talking heads are out there trying to keep people invested because they're in the background selling.
That's the good key point there. I, at least for sure, is why does he want to tell you what he's invested in? Probably because he wants to get out of it.
Yep. Drive it up, push it up. Then that's all those big talking heads. That's kind of what they're doing. So
Jim Cramer included.
Right. Yep. Another headline, from Business Investors Business Daily, who wants to have you invested, wants you to have you logged into their stuff. They said there's still time to own 13 stocks that'll finish the year strong. Why settle for stocks limping to the finish line? Some investors found S&P stocks that finished the year on a high note. So, I mean, I think we've said this, maybe obviously not in this video, but we've talked about the fact that all ships move in the same, on the ocean. So it doesn't matter what stock you're in. If we're in a true bear market going forward, it doesn't matter how great, how fundamentally strong the stock is, it's going down.
Mm-hmm. Yeah, we'll get to see you swimming naked here pretty soon.
Hopefully, yeah.
Well, we saw the first cracks of it the first part of the year with the banks, or with Silicon Valley Bank, rather.
Right, and we're still having problems with the banks. Like I think earnings comes out today on some of the bigger banks, and they're a little more stable because they control the money supply. So
the entire market. Yeah.
Right.
So all what was it? Wells, Chase, and was it U.S. Bank? What was the other one? Chase, City, and Wells, and I'm sure a few others, but those for sure all beat earnings this morning.
Yeah. Well, and one key feature to that too that we're seeing a lot, especially in the past couple of weeks, are bankruptcies. There's a lot of bank bankruptcies, company bankruptcies. There's a lot of strikes happening. I mean, you got the UAW, you got
Mm-hmm.
there was another strike that went on. You have the Kaiser Permanente unions
Yeah.
that are striking. This is all indicative of a bear market kind of mentality and philosophy, and it's just kind of funny that these are not getting enough publicity and enough postings out there of what's going on, and that the fact that that's going to drive unemployment.
Yeah, you don't see a lot of, even just as we go day to day each week, you don't see a lot of articles that are like, you know, I guess doom and gloom for lack of better words, but it always seems to be these positive articles or these positive spins on, oh, well, the market's been down for the last 2 weeks, but hey, we're coming into the best part of the year. We'll see. I mean, I don't know about anybody else who's going to be listening to this someday or is listening right now or whenever, but I mean, I went to the store last night to buy tacos to make, ground beef tacos for dinner. I only bought ground beef, onions, let's see here, salsa, chips, and avocado, and I spent $50. Oh, and a
Yeah.
jug of
I mean,
that.
that same thing would have been 30 probably 2 years ago.
Uh-huh. So
Yeah.
I think this is a good segue into the other article I wanted to bring up, which I thought was pretty funny. And both Patrick and I kind of fall into this, but we're not these idiot pros. Is what I'll say. So this is from new investment news. So Wall Street pros lose 10 billion in Treasury ETF, but many keep hoping. So it's kind of funny because it seems like they're doubling down on their bets. And so the ETF they're talking about is TLT, one that you and I have both, you know, been in and out of over the years. But what I think is funny is, they're all banking on, rates not really going much higher. Like this is kind of maybe a temporary pause, and we might get a little bit of that rates are going to come down is really what they're hoping. And I'm of a different mindset. I mean, I think if we get a little pause, maybe a little sell off, but then we're going higher. I mean, inflation is going crazy. I mean, like I just explained, going to the store and buying less than two handfuls of stuff and spending $50 is insane. So I
Yeah.
don't.
You, you still hear the people talking how they're going to cut rates, and rates are going back to normal, and all that type of stuff. And in the beginning of all this, I would was kind of in that camp too, that rates will reset, and I do think rates will reset over the long haul, but they're going to reset in a new normal. We're never going to see a 3% mortgage. I don't think that's not going to. It's just not going to
Yeah.
happen again in many years. We might briefly, maybe it'll dip down there, but we're now in a new trading range type of thing that's going to happen going forward. So, and
Well, in our
to
I mean,
kind of go in, go ahead.
oh, go ahead. No, go ahead.
I was just gonna kind of move to like an article that I found that kind of goes in line with that. Is that their treasuries have been beaten down, or bonds have been beaten down because the yields have gone out. But there's an article on Investors Business Daily too that came out that said only 11 stocks have a dividend that can now beat the treasury yield of a 6.8, and that was a couple weeks ago. So, and now we're closer to almost 5. I think there are more stocks than that, but that's just showing that the shift is eventually, and that might be the near term lull that we have, because there's going to be people moving out of equities to lock into that higher yield that bonds are getting. Because if they can get a 5 and not worry about it and hold that thing into retirement, now they're getting a 5% coupon.
Mm-hmm.
People are going to start to shift in there. And that's when they do that, that's going to start to bring the prices back up and the interest rates back down.
Yeah. So, I mean, I would say, is this fair to say, Patrick, that we're of the mindset we're invested in TLT a little bit, but we're not, we're waiting for a bigger situation. I think the adage is, short term maybe, you know, goes within a range. Maybe we get rates will come down a little bit, like get everybody all excited, and then, back up and, shooting who knows where, but, at least over to 8-9% on a mortgage.
Yeah, I mean, it's still a lot of uncertainty, but yeah, that's kind of what we're hedging against. We get a little bit of that reprieve.
The other thing that I've found interesting too, at least over the last, this year for sure, and last year partly, but this year for sure, is there really hasn't been much talk about inverted yield curves. And pretty much like every textbook when it comes to finance talks about how terrible an inverted yield curve is, and that, what lies ahead is a hurricane category 5.
Right.
And nobody's talking about it. And it's been going on now for, this entire year practically, if not the whole year.
Yeah, almost a little over a year. It's usually
Yeah,
9 to 18 months or whatever from when it
right.
happens to the recession. But what blows my mind in that is that two parts. One, it's kind of a mental aspect of things, because so what if shorter term rates get you a better rate than longer term? It's a little counterintuitive, but in reality, it doesn't matter. The problem comes into play when people are already invested in that long term and they're shifting, type of thing, or they need to refinance, or all those type of deals. That's where the problem starts to snowball. But I mean, if you're free market constantly moving, a true free market, it shouldn't matter. If you really look at the bigger picture of it, it shouldn't matter if you're always evolving and changing and adapting to the times, because it's just a mental aspect of things. Oh my God, I can make more money by a 3-year than I can holding it for 30 years, type of deal. It really shouldn't impact the market that much,
Yeah.
if we have a true free market.
Yeah, agreed.
At least in my opinion.
Well, we share the same.
The last thing that I wanted to mention that's not market related, and it might get a little political, but IQ scores in the US have dropped for the first time in nearly 100 years, studies suggest. So tech is making us dim, is what they're saying. And I would argue it's not the tech. It could be some of the tech. I would argue more the fact that it's more our school system has been underfunded for so many years. And two, our immigration policy has taken a huge shift. So we're no longer bringing in the educated from around the world. We're allowing open borders along the South. So we don't have the high quality of people immigrating into our country anymore that I think is having a big impact on things. So I just thought it was interesting that the US is getting dumber for the first time in 100 years.
Well, it's true. I mean, I've seen it since I graduated high school 20 years ago. It's SAT scores, ACT scores, whatever else they use I don't remember what they use for elementary and middle school, but I mean, math, science, English, history, everybody should at least have some of that. But for sure, math and science, and English, I mean, it's really bad. And I wasn't a great student, believe me. Let me show you my records, and I like to dick around more than actually study for things.
Well, and that's the American philosophy. I feel like, that's how we approach things. But it's just, I think there's more to it, and the money that we send out into other, that's my biggest thing about it. Like, I feel like that's why we're getting dumber. It's not technology. Technology should assist it's our poor funding in the school system. And that, going back to the unemployment aspect of things, I think there was a school labor that was striking. So, I mean, it's just, and they're striking for their kids, they say, but teachers are underfunded. I mean, my dad was a teacher for almost 40 years. He did not make money. So,
well, I think one thing we should talk about one of these times for sure is the unemployment numbers and how they work. Because I think a lot of people are sorely mistaken, and each month when they come out with unemployment numbers, like, oh, unemployment's down, unemployment's like, no. You need to know why it's what they're missing every time, because usually go ahead.
Well, we'll segue that into the next one. We'll talk about it, because something that should go with that is the revisions. We've revised every number, CPI, unemployment figures, all that stuff for the last 12 months. They've revised it higher. So, I mean, that's a great cliffhanger for maybe the next episode.
Yeah, no, I agree. I think we should talk about it. I also think, we'll get into that one for sure. So I think, you find one, I'll find one, and then we'll bring it to everybody next week as one of our topics to go over.
Yep. Well, there you have it, folks. Make sure you tune in next time to the Half Truth, where we break apart smarter minds than us.
That's for sure.